Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Are you interested in Lyft, are you? We're financial advisors here at Jazz Wealth. We manage our own portfolios. We build our own portfolios, expense-free funds here because we manage them. And so we work with customers as far as retirement accounts, financial advice, and everything along the way. We teach. We're also financial advisors that believe in teaching. Well, one of the things I want to do is teach you today. Lyft is one of the IPOs that is coming out. Now, if you're not familiar with it, I'm going to try to include some of the beginner stuff here and some of the more advanced stuff for those that are looking for it. If you're going to invest in Lyft, there's a few things you want to know, and of course, we're going to cover it. And I hope to cover this in greater detail than anyone else here on this platform trying to cover Lyft, because I sort of want to show off, hey, look what we do, look what we know, and then maybe it'll keep us in mind at Jazz Wealth. Now, last Friday, today's March 6th, by the way, as this is being posted. So last Friday, Lyft filed their S1. Now, the S1 is simply the last stage before launching an IPO. An IPO meaning you initially price your shares to the public. So an S1 essentially is just saying, we're definitely doing this, right? The next stage is to come to the public, offer our shares, and hopefully raise a lot of money. Now, there's something you want to know. There's a lot of controversy around this IPO for a couple different reasons. Why does that look so bad? Better, right? So there's a couple reasons this one's a little more dramatic than others, and I'm going to attempt to try to teach and explain as we go here. So the first thing we want to cover is there are two classes of stock in Lyft's IPO, okay? So there's going to be Class A, and Class A, it works just like every other type of stock. You have one share, you get one vote. So one share equals one vote. This is very normal. There's also going to be a secondary class of stock, but you're never going to see it because the founders are going to keep it for themselves. And this is where the controversy comes up. There's something called Class B shares that the owners or the original founders themselves are going to keep. And this says for every one share, they get 20 votes. Oh boy. You can very quickly see that no matter how many shares you buy, they've worked it out, no matter how many shares you buy, you are not getting a say in whatever happens with the company. Now, you may not care because you're just simply trying to make a profit. You're saying, I would like to invest in a company that I see share price appreciation, the value goes up, I'll sell my shares, I'll make a profit, it'll be great. Now, the founders of the company are going to own less than 10% of the overall Lyft company as it becomes public. So that's the frustrating part, right? They own less than 10%, but yet they have commanding control over what happens with the company. A lot of people are upset about that. There's actually even a petition to the exchange to say, hey, don't allow this. Now, one of the things, it's not that they don't want to allow it, it's that they want to have what's called a sunset period. And so a sunset period is essentially saying you can do it this way, one share, one vote, and then the founders can keep their shares with 20 votes. But if we do it this way, we'd like it to only be left like this for some period of time. The sunset period just means after a certain amount of time, all that goes away and we transition everything into a one share, one vote type system. Give you an example, Groupon did this. There's a little difference though. Groupon did it and they said, we're going to have one share for one vote to go to the public, and our founders are going to keep one share for 10 votes. And we will do that for a period of 5 years. After 5 years, they will move into where everybody's equal. You have one share, you get one vote. Facebook has also done something similar. Alibaba, if you follow them, symbol BABA, has done something similar. Google, or Alphabet, if you want to look at it that way, they have done something similar as well. So the argument or the sort of uproar with the Lyft IPO is there's no sunset period. These guys are saying we are going to control the company indefinitely. You can buy shares if you want to sort of participate in, hopefully, the price appreciation, but that's it, right? So something you want to keep in mind if you're interested in having a big position or having a say in a company, you're just not gonna. It's not gonna happen. Okay, so we're focused on Lyft today because a couple reasons. Number one, it's the first big IPO of the year. Well, it will be the first big IPO of the year as of now. We have Uber, Airbnb, Slack, Pinterest. These are all names that are big and sort of not household names, but bigger names that could be going public. we're talking nearly $1 trillion in potential offerings or money that these guys are going to try to raise across all those IPOs throughout the year. So it's a big deal. Not only that, you've got Uber coming up. They want to do their IPO this year as well. And so it's grabbing a lot of attention. So let's look into the company here. Let's dig a little bit deeper and see, is this something you want to invest in? I'm not going to give you the sort of advice one way or the other. I'm not going to tell you what to do, but I will give you the sort of details of what's going on here. So let's zoom back in and talk about what they've got going on. So in their financials, this is not my advice or anything. This comes directly from them. In their financials, they did about 600 million rides, right? So we'll say 600 million rides last year. That's pretty impressive, actually, if you think about it. It was like 300 and some million of us. They did 600 million rides. Now, of that, they brought in $13 per ride, right? Not bad either. If 600 million rides, you got, let's say, about $13 per ride, which means they have about $8 billion in overall bookings. So it would seem that with $8 billion in bookings, things would be going pretty well, something you may be interested in participating in. Let's dig a little bit deeper. With the $8 billion, about 75% roughly gets paid out to drivers. So they actually do pretty well. They pay about 75% out to their drivers, which leaves them with a total of $2.2 billion after everything's said and done, right? Of the $2.2 billion, do you think that's all profit? Do you? If I made $2.2 billion, you'd think I'd try to find a way to make some of that a profit. However, with Lyft, they have a total of $3.1 billion in costs. You can see very quickly the math isn't adding up in that case. So what's happening here is as they grow, their riders, their revenues, their bookings, the rides that they do, those are all starting to decelerate a little bit. In other words, if we were to show a chart, I didn't put anything fancy together, but if I were to put together a chart of their rides, their overall rides since 2016 have started to sort of taper off a little bit. Their overall revenue has started to taper off a little bit. The overall bookings have started to taper off a little bit. It's not that they're doing poorly, it's just increased competition. So overall, as they get bigger, they've had to increase their take rate. So that's a number you're going to see a lot, and as they report earnings, you're going to hear more about what's called the take rate. Their take rate looks something similar to this. Think about it. And take rate is just how much the company's going to take. Their take rate is now close to 30%, right? It used to be down here at 16%. So, as the company grew, their competition, right, everything's costs, everything is sort of increased, which means their overall revenues, their overall bookings, their overall sort of operational, everything has started to decrease. They've had to take more from riders. So they're at 30% now. Now, that's just a number. Is 30% really a high number, or is it a low number relative to what? Their competition. Who's their competition? It's Uber. So if we look at Uber, they're currently sitting at a 20% take rate. So what's the projection here? I'm going to get a little geeky. I'm sorry. I'm going to dig in a little deep here. So as their revenue, their riders, their rides, their bookings are all sort of decelerating, they're raising their take rate. That can't continue forever, or everybody's going to move on to Uber, right? So every analyst projects that their take rate is going to flatline closer to the mid-20s. They're going to have to remain competitive with Uber. So again, it's not my information. I'm just digging through this with you as we've kind of found the stats of all this stuff. If Uber's at 20% and they're cutting costs and they're trying to be more competitive, then certainly Lyft is going to have to find that they lower their take rate. What does that mean? If they lower their take rate, it means that overall they're bringing in less money, right? So if the company's bringing in less money, they're reducing now the amount that they take from riders, or will sort of have to reduce the amount that they take from riders, then what do you think is going to happen? You now have a company whose costs are going to go up. So if you are investing in Lyft, you're thinking about buying this IPO, what are you really doing? You're investing in the potential for a company to reduce costs. Simple as that. All that stuff we just said boils down to your belief that if you invest in shares of this company, which give you no voting rights, that you will be able to see them, the people that have 20 votes per share, you'll be able to see them reduce costs. Now, almost every analyst out there shows their projections for net losses for the company to start slowing as we get into mid to late 2020. So is there a hurry to buy into a stock? Well, here's the thing. The stock price will see appreciation if they can show their net losses dropping. People will believe that that trend will continue and eventually they'll turn to a profit. But for now, one of the only ways that they can start moving in that direction is if A, they lower their take rate. They're going to have to lower their take rate to be more competitive, especially as Uber starts to gain the spotlight with their IPO. And the other side of that is if they can reduce overall costs, because as they lower their take rate, that's not helping their costs at all. They're going to have to lower their costs. So there's a little work to be done here. You can kind of see why, even if it's promoted that this IPO is the most exciting thing you've ever seen, is it? Is it really? You're investing in a company that is losing money and projected to continue losing money. They're only projected to be losing less money by 2020. And so you're really betting on these guys being able to reduce their costs. I'll give you a hint. Snapchat was the same exact way. You were betting on a company being able to reduce costs, which would help them turn a profit. We were also betting on their advertising efforts and everything as well. But that was a big focus. They were not able to do that and still struggle to do that. So do you fall for Lyft? Do you dive in and start investing in that company? I'm not going to tell you what to do. I just want to tell you what you're to expect out of the company, and that is simply cutting costs. Well, hey, I hope that helps you. I know it was a little bit detailed, probably a little more than we normally do. It's just trying to show off a little bit of what we kind of help customers with here. We'll see what happens. I'll be covering the Lyft IPO, of course, on the Closing Beat. That's our 5 o'clock show that we do where we cover the stock market every single day, live, by the way. And if any of that helps you, maybe you'll hit the subscribe button. If you found that this is helpful and you want someone like Jazz, us, me, to be on your side with your retirement investments, can you imagine the sort of research we do for that? We'll have to do a class publicly that we normally say for our customers one day. But anyways, I wish you the best. We'll be looking for that IPO to come out soon. And hey, thanks for watching.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.
Hey, wait! Before you go watch one of our other great videos, have you had a chance to see our new FinTips videos? They focus on one topic at a time, covering investing, personal finance, and anything that can quickly help you with your dough. Best of all, we'll keep it real short, because we know time is money.